Jobs, jobs, jobs. Here we are, the first Friday of the month. We've got the non-farm payrolls report came out for the US. Basically came in really hot and basically said that, hey, the labor market's doing really well and there's a lot of jobs in the economy. Well, let's take a look. Non-farm payrolls, the headline number came in at around 517,000 versus the expectation was 185,000. So the actual came in 517,000 versus the expected 185,000. Now last month's number was revised higher to 260,000 versus 223,000. So up a little bit, but definitely this month's report came in way hotter, way higher than expected. Now, the average hourly earnings, which talks about the wages, the wage component of the non-farm payrolls and the jobs data, also came in at 0.3%, which is actually in line versus the 0.3 expected. But the revised numbers of the last month came in at 0.4%, which is higher than the 0.3% expected. So 0.3, what they had before, they looked at the data and said, oh no, actually it's not 0.3, it's 0.4. It's actually higher than what we reported last month. And then you have the unemployment rate for this data point coming in at 3.4% versus the expected of 3.6%. Better than expected. I mean, amazing. When you look at these numbers, you're like, holy cow, the job market's doing amazing. No recession. Recession's canceled, right? Well, that's what the establishment survey would tell you. And when you look at another survey, like the household survey, yeah, there's an increase, but not much, and not much as expected. So what's going on here? Now, before I get into that, my name is Daniel. You're watching InfoVest. InfoVest is an organization that promotes financial literacy, and we teach you about the macroeconomics and teach you about how the markets truly work and what our views are and how we look at the markets, the financial markets, and most importantly, how we look at macroeconomics and what it means for all these products that are trading out there. So if you're interested in videos like this, subscribe, hit the like button, comment, hit the bell icon to be notified on the next video. If you want to learn more about macro investing and trading and how that applies to the current environment, we've got courses on our website. You can visit www.inforvesting.com for those details. Now, 8:30 a.m. we got the non-farm payrolls when numbers came out. We also had at 10 a.m. the ISM non-manufacturing numbers come out, also better than expected, right? So ISM came in at 55.2 versus the 50.4. 50.4 was the expected, so it came in higher than expected. And the previous month was 49.2. The number last month was suggesting that we were basically in a recession territory, recession area, according to the ISM number last month. But the number coming at 55.2 basically says that, hey, we're back to normal again. We're back to doing okay, right? ISM prices also came in at 67.8 versus 68.1. So not bad, a little bit lower on the prices. Now here's the kicker. The new orders came in at 60.4 versus the expected of, if I have my numbers right, it's a little bit hard to read on this chicken scratch, but I think it's 45.2. That's a massive beat on the new orders. And then employment, ISM employment coming in at 50 versus 49.4. So it's saying here, hey, we're doing fine. No recession here. We're all good. And what was the reaction in the stock market and the bond market? Well, right at 8:30 a.m. when you had the non-farm payrolls come out, stocks and bonds both sold off right away as soon as that number came out. 9:30 came, cash market open, Markets were trading live, and we saw a reversal in the stock market. However, the bond market continued to stay where it was and even continue to sell off throughout the day. Then you've got 10 a.m. the ISM numbers coming strong again. Manufacturing data strong, employment strong, prices somewhat coming a little bit down. And what happens? Stocks go up higher and bonds continue to sell off. What's going on here? What's the message? The bond market's telling you that, hey, strong data is not good. Sell off. It means higher rates, means higher yields. And the stock market is now back into the mode of good news is good for stocks. I thought bad news was good for stocks and good news was bad for stocks. But now we're seeing good news, is good for stocks too. And woo, we went up after 9:30 a.m. and then 10 a.m. we went up even further. However, throughout the day and heading now, as I'm doing this video, it's around 3 p.m. The markets have basically retraced all that move and it's coming back down, heading to the close today on a Friday, and we're making lows on the day. Complete whipsaw back and forth in the markets. The equity markets are confused. 50% of the people are looking at this number as if it's good, soft landing, no recession, buy it. The other 50% are saying, hey, yes, Fed gave us the green light that, it looks like they're coming to a pause and a cut maybe soon. But he did say we will continue to raise rates, and he didn't put a marker of where it's going to end. However, in the last projections, he said 5.1%, but that could definitely change. And that could definitely change, especially if data continues to be robust and strong. And if that continues to be the narrative, then I don't see how stocks can have more juice to go up higher unless they're high on the narrative that, hey, soft landing and no recession, that's good. Fed's not going to do anything. We're calling the bluff of Fed. He's pausing. He's going to help us. The Fed's got our back. So economy's doing fine. Labor market's good. Fed's got our back. Juice up the markets. Bring it up all much higher. Now, I want to go a little bit further detail into this report. So I talked about the household number for the non-farm payrolls. I didn't talk about the house. Sorry, let me repeat that again. I talked about the establishment report, which was the non-farm payrolls. I didn't talk about the household number. So I've got a little bit notes here. The household number came in at 265,000. Okay, little bit increase, but not as much. If you look at the past 6 to 9 months, the household number basically has been flat. So the establishment survey, the number that you're seeing out there in public by the BLS and by the news agencies, that came in real hot at 500K. But if you look at the household number, it's been stagnant. It's been but the number has been sideways for some time. There hasn't been much of a change. So what's the difference? The establishment survey basically double counts a lot of the jobs. So for example, you're working 2 jobs, it's going to count it as 2 in the establishment survey. But if in the household survey, if you're working 2 jobs, you're 1 person, it's going to count it as 1. So that's the big problem between the establishment and the household survey. So that's why it's better to look at the household survey to get a better idea, right? Now, the household survey came in also a little bit higher. Establishment survey came in crazily hot. Does that mean we ignore the establishment survey, completely not listen to it? And you know what? It's hard to answer that question because you have market participants looking at that, making a decision off the establishment survey, and then making trades based on that establishment survey. And the markets are moving based on the establishment survey. However, yes, you got to look at the household survey, the household numbers, because that gives you a proper picture of how the labor market is really doing. Now, when you look into the household survey and you look into the survey and you look into the jobs numbers a little bit more deeper, we also see the full-time numbers. Full-time employees have increased by 200, and but however, the number has been still relatively in line. Not much fluctuations, not much big changes there. Next, and we see this inline movement for about 9 months, okay? And now next, the part-time workers have increased by 600 workers. So you're seeing part-time starting to increase and the full-time, still in line. And again, goes back to what I was saying. If you're working 2 part-time jobs, then we call that 2 jobs in the establishment survey, and that's depicting a wrong picture. Now, what else is showing the establishment survey? What else is what caused this big move in the establishment survey? Why is it so off? Why is it so misleading? What happened here? It's so unbelievable that number came in around 517K versus the expected 185, and we're saying, yeah, more jobs. This is 100% misleading, and this is probably a calculation error from the BLS. So what could it be? Well, every January in the establishment survey, the reports basically add some adjustments, some seasonal adjustments into every January's report. Okay, new year, got to add the adjustments. And the adjustments come from last year. Right? They look at last year's jobs and they say, okay, last year jobs, we didn't count this many people in the previous jobs report. So instead of updating the previous jobs report and putting it there, they're just taking the jobs that they missed of that last year and adding it to this report. So it looks like it's bigger and better and better. Right? So again, misleading. Once again, the non-farm payrolls report looking really strong is actually misleading because you're adding these adjustments that are not really true. So that's what's making the number pretty high. The other thing that makes the data so misleading, and I'm here again reading in my notes, so don't mind me, please. And it's chicken scratch, my writing, so it's a little bit hard to read. But going back to why this number is misleading is because, and why this data is unreliable, is because not only you have the adjustments that is adding into this report, for many months down the road, you still may see the establishment survey come in stronger versus the household because it's not factoring, yes, it's double counting, but it's not factoring also that, hey, we are seeing that job losses are happening and we're not seeing it in this report. So why is that? Why can we see this number for the next couple of months continue to look strong? And the reason is because when you have tech workers coming out and they are on severance, right? Severance pay for about, it tends to be around 12 weeks. They're not reporting that they're out of the job in those 12 weeks. So that's what can cause a little bit of also the data in the next coming months still to be off and still misleading. So one is that. Second is the tech workers are also, some of them who are working right now, hearing that their company is laying off people, are going out and also applying to jobs, right? So imagine you're working at a company, you are hearing that people are getting laid off, and you get an announcement from your management that, hey, we're going to be conducting more layoffs. You're going out frantically applying to jobs, which is also creating that effect where if you are fired or let go, then you have probably by then another job lined up and you're working there. So again, the number looks fine, the number looks great. So these are not being accounted for in the report as well. And on top of that, if the data counts 2 jobs, that you now have, then it might double count it also in that report. So what do you do, right? What can you do? It's not much really what you can do other than looking at other data, other leading indicators out there. But one thing's for sure is that the household is better to look at rather than the establishment survey. And it's very dangerous because if this establishment survey continues to come out stronger and better, what does that mean in terms of the Federal Reserve and their rate hike? Now, we heard from the Fed that they're going to slow down, they're going to pause. But the data that the Fed looks at is lagging. And the history of the Fed that we've seen has always made mistakes in the past, and looks like we're going to see mistakes again in the future as well. And with those mistakes, if the Fed continues to tighten and shocks the market by over tightening and raising rates to who knows what level, maybe 6% or higher, it will definitely cause shock waves to the equity markets. And the equity markets, and how you would figure that out, is if the data continues to be stronger and stronger and is showing signs that things are not getting weak, maybe the equity markets may panic on that, thinking that the Fed is going to pull pull something out of the hat where they raise rates more aggressively. Now, if that's not the case, and we see data strong, and they believe that the Fed is not going to do anything, and the Fed does confirm that they're not going to do anything about it, then sure, you will see a continuation of the rally in the equity markets. However, the bond market may be a different story there. Again, depends on how the data comes out and how the Fed manages the expectation versus the expectations that the markets has versus what they're saying. And if they come out more hawkish, then sure, you're going to see the bond market, especially the short end, sell off more. But if the bond market starts seeing something that, hey, this data is misleading and the Fed is tightening more, then it's going to cause a panic in the bond market, and maybe you might see a massive rally in the bond market. It's very hard to judge and say. But definitely, you want to keep an eye out on the data. You definitely want to keep an eye out on the jobs number. And it's very crucial because if the Fed reacts to this, now the key is if the Fed comes back and reacts to it. We know that, okay, a lot of the central banks are now getting to a point where they're getting close to ending the rate hikes. But if they flip, or if there's any signs of more tightening, it's going to send shockwaves. And if they do that, because of this lagging, misleading number, and they over tighten and then something breaks, then you could probably hear the Fed come out and say, hey, the BLS is at fault. The BLS gave us the wrong numbers. And that would probably be very, very bad to hear from them, that they were acting on numbers that were completely misleading, and there would probably be very little trust in those numbers or in the system or how the way they calculate certain things. Maybe they won't reveal that, or maybe not, we don't know. But if they are making their decisions on these lagging numbers, and they are going to continue to tighten on these lagging numbers, if they flip completely, it's definitely not going to look good. Now, if they don't, and they continue to sound dovish, then sure, the equity markets will rally until maybe something breaks. And there are signs that something is coming. And how do you tell that sign? It's not from the strong establishment report. it's from looking at the household that there's signs that the job market is really not that strong as the establishment is explaining it to be, because we've been stagnant in the number and trade. Really, the number's been sideways for more than 6, 7, 8 months. And generally, that's a sign that once the jobs go up, they're in line stagnate, you could probably see the next trajectory would be the jobs coming down. And when we get to that point, and you start to see it and it starts to reflect in the establishment survey, maybe a quarter or two later, maybe in the summer of this year, or maybe September of this year, then you'll start to see, okay, that there are some cracks, and maybe bigger, deeper cracks, not craps, but cracks that are showing in the economy. So biggest thing is that this establishment survey that you're reading out there, that you're listening to, it's misleading. And it's crazy to say that we've added this many jobs. I don't agree with that number. I think the number is definitely misleading to all who reads it. And just be careful. Let me know what you guys think. Leave a comment below. Hit the like button, subscribe, and the bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.